Thanks for joining us on Parlance. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Dugal. Let's get straight to the headlines. Indian markets going into the Christmas weekend on a happy note. Nifty hovering around the 10,480 mark. TCS Bharti Airtel gain.
Adani Transmission rallies almost 10% after buying Reliance Infra-Adani's Mumbai power business for $2 billion. Anil Ambani Group company stock rises as much as 7.5%.
Stress in the Indian banking sector may be high, but it may be close to bottoming out. That's the key message from the Reserve Bank of India's Financial Stability Report.
Wind power is now the cheapest energy in India. Tariffs dropped to a record low of 2 rupees 43 paise per unit. Weekend cheer, Christmas cheer is all here. You are seeing the markets rallying afresh, and there are fresh legs into the market today. Neeraj is here to take a closer look at some of the stocks.
Yeah, well, 15 points away from 10,500 from all-time highs, about 10 points away. But yeah, it's not a bad day of trade. One wouldn't have anticipated this. You would have probably thought that heading into the long weekend, we would have a quiet whimper kind of a day. It's anything but that. Let's wait and watch if this buckles down or no. But for now, it's doing rather well, and technology seems to be at the forefront. So not just the large cap space, but across the board, maybe buoyed by Accenture's numbers, but all of those stocks seem to be doing okay. So Infosys, TCS, the mid-sized names, the likes of, and they're not really bucking the trend. They are the trend. So TCS, Infosys, L&T Infotech, Polaris Consulting, all of these stocks are doing rather well for themselves. Volatility's come off quite rapidly. So from the levels of 12.1 or thereabouts, we are now at 11.8 odd. So this week has been a marked slowdown in volatility, or a drop down in volatility, which is something that bulls would anyways like. Just looking at the broader end of the spectrum, you guys spoke about the Adani Transmission and the Reliance Reliance infrastructure deal. And after a rally yesterday, another 5% apiece for both Adani Transmission as well as Reliance Infra. So that's good going. 2 days cumulatively, both of the stocks have done over 10%, which is actually a pretty good sign in the session. And a clutch of broader end of the spectrum stocks rallying as well. But I thought technology stood out, these two stocks stood out. And then some of the infra names, the road construction companies, are doing rather well for themselves in trade today.
All right, Neeraj, thanks so much. That's the equity markets. Actually, ironically, the debt markets are not looking that great. Once again, there is news that has come out, or just flashes of news that have come out, which has pushed the 10-year bond yield higher again. It's been trending higher pretty much through the week. And if you pull up the 10-year chart right now, you'll see that yields touched almost 10.27. Pull up a shorter duration chart, and you'll be able to see the impact of that news coming in that the excise duty cuts on fuel items could cost the government 26,000 crore. I'm not sure why that's a surprise. So just take a look at the daily chart if you can pull that up, because I mean we would have expected that the cut in excise duty would have cost the government, and I'm sure the estimates were not that tough to pull up. But you got some flashes on news, and the market reacted. Just tells you the kind of mood that the market is in. Very, very bearish. And Bharat Iyer of JPMorgan, who was with us earlier today, we'll play out a conversation a little bit later. But he was making the point that there is a bit of a standoff between the equity markets optimism and the debt markets pessimism, Harsha. And he said that one of the two have to give in. Either the debt market has to give up this pessimism and move towards the equity markets mood, or the equity market has to give up and move towards the debt market mood. I thought that was a very, very perceptive comment, but the debt market not happy today.
Let's give you the contra view. SocGen, high valuations and slow earnings recovery have turned SocGen underweight on equities. They prefer investing in the debt market. Nupur Acharya from Bloomberg News is here to tell us why they prefer debt to equity.
So as you put it, what SocGen is saying is essentially on the minds of a lot of investors, high valuations. So they're saying that presently the risk reward is unfavorable, given that the valuations are high and the earning recovery has been slow. And you also have to look at the macro winds, the tailwinds which have been supporting the economy's growth. Inflation is looking up again, and the hopes of any interest rate cuts are fast fading. So in this kind of a scenario, they believe that going into debt is much more beneficial than equities.
Is there a time frame that SocGen is looking at, or for earnings recovery? Are there any sort of, or are they concerned about stocks for all of 2018?
So it's good that you asked this question, because it's a very near-term view which they have right now. The long-term strategy remains to be a buy on Indian stocks, because they believe that the economic reforms process will continue, and which will finally lead to better tax collection. You'll have better corporate governance and overall better formalization of the economy.
What do they call it? A tactical view, is it then?
Yeah, tactical move. Yes, that's true. That's true. But they feel about bonds that 7.25% should be the yield on the 10-year. That is the forecast. And as we speak, it's currently at 7.27, 28%. Yeah.
But I think yesterday there was a Bloomberg News survey that had done, which had said the upside could be as much as 7.5.
That's right.
There were some people predicting that. Nupur, thanks so much for that. Those are the views conflicting, changing, coming in on the debt and on the equity side. Of course, we've got a bunch of macro conversations coming up a little later in the show. We will hear from Subir Gokran, his views on this entire fiscal story, and we'll also hear from Bharat Iyer on that valuation issue. All right, let's get across and start talking about corporate news. Adani Transmissions will buy Reliance Infrastructure's Mumbai power business for 13,251 crore. That news came in yesterday. On the one hand, it helps the debt-laden ADAG group to bring down some of their burden. On the other, the deal marks Adani's foray into power distribution. Jayesh Khalnani is standing by with the contours of the deal, but also what markets and brokerages are making of it. Over to you there, Jayesh.
So, Ira, what Adani Transmission is essentially going to get is the generation, transmission and distribution business from our infra. Now, the deal structure goes like this, that they will get 13,251 crores. That is the total value of the deal. Along with this, Adani Transmission is also scheduled to get the regulatory approved assets worth of 5,000 crores and net working capital of about 500 crores. So, summing up, the entire deal consideration stands at about 18,800 crores. What will happen post the deal is that our infra is likely to become a debt-free company with an excess cash surplus of about 3,000 crores. Current debt of the company as of September quarter stands at about 23,300 crores. Now, our infra, what they've mentioned in their press release is that they are going to focus on the asset-light, EPC and defense businesses going forward. In line, based on this, JPMorgan has come out with a note and they are extremely positive on the stock of our infra. They have an overweight target price with 630. Current price of our infra is about 530. Remember that yesterday post this announcement, stock did jump 10%, and this morning we have seen another 5% jump. But still, the target price still leaves a room of about 100 odd rupees. According to JPMorgan, the total deal or the equity value of the deal stands at about 6,250 crores. That is twice the regulated assets that they have. And what they are watching out for is essentially the roadmap for the EPC and the defense business. What they are going to do going ahead.
Thanks, Sajesh, for that. Let's in fact listen to the management of the company. Purva Chetty is caught up with the Chief Executive Officer of Reliance Infra, Lalit Jalan, on why this deal makes sense for them. Listen in.
This is about a Mumbai power business, which is our Bombay distribution, together with the associated transmission and the Dahanu Bar station, the integrated Mumbai power business. And this is for 100% sale of this business. The total value of the transaction at time of closing will be 13,800 crores, and then there will be a deferred compensation, which will be the regulatory approvals which are under approval. These are totaling to almost 5,000 crores. We expect most of these to get resolved over the next financial year. So the total transaction will give to the company almost 18,800 crores.
Right. So what kind of debt would be transferred to Adani?
The entire money that we receive from the transaction will be used to reduce the debt. The total debt at Reliance Infrastructure level is 15,000 crores, and this entire 18,000 crores that we receive will be used to retire the debt. So we become debt free, and we become almost 3,000 crores cash surplus.
So you said there's a 3,000 crore cash surplus as well. So how does Reliance Infra plan to deploy this cash?
The cash belongs to the shareholders, and we are truly looking at asset-light businesses, which has been a strategy which we have announced in our various interactions with the media. So our focus areas are going to be the construction business, which does not require capital. It's a negative working capital business. So that's going to be a very big focus area for the business. And the defense business, which is also a very asset-light business. So these are the two big verticals on which the company will grow. The other verticals of Reliance Infrastructure namely the Delhi power business, which is twice the size of the Mumbai power business, the roads portfolio, the Mumbai Metro, our Reliance Power investments. These are anyway self-sustaining. We don't see investing new money into those businesses. Whatever capital expenditure that they require, they can spend from their own cash generation. So infrastructure does not need to fund those monies. So this money remains with Reliance Infrastructure, and we focus on the capital-light businesses.
So when can we expect this entire deal to be completed then?
We have got the requisite approval from Mumbai High Court to demerge the business into a 100% owned SPV. We now need the MERC approval for transfer of license and subsequent sale to Adani. We expect to get the approval over the next 2 to 3 months, and we are very, very confident that we'll be able to complete the transaction in the next quarter.
So are there any new areas that Reliance Infra plans to enter?
Currently, our focus areas, as I mentioned, is the construction and the defense business. We are not looking at investing large sums of capital into new businesses. So these are our business focus areas, and we continue to do what we do good today.
And final question would be, so this deleveraging exercise that Reliance Infra has started, can we expect with this deal it is complete, or are there any new areas that we need to keep an eye on?
No, so you're right. The deleveraging exercise that we announced 3 years back is now complete with the sale of the Mumbai power business. So we did not do any more deleveraging to pay down the debt. Having said that, the growth businesses are what we have. The other businesses, if we can create value for our shareholders by monetizing part of them, then that's something that we will always be looking at. Any deal which is value creating for our shareholders.
All right, Accenture has reported a strong set of numbers for the quarter ended November 2017. Does that indicate a better time ahead for the Indian IT sector as well? We've got Agam Vakil joining us with the details on what they reported and what its implications could be for Indian IT. Agam.
Sure, Ira. Let me start off with how Accenture has done for the quarter ended November. What we're seeing is about a 10% growth in terms of constant currency on a year-on-year basis. And Accenture has not only beaten street expectations, but is also above its guidance of around 5 to 8%. Of course, with respect to its guidance as well, it's increased its lower end of the guidance from 5% to 6%. That said, it's really done well in application services and operations, and we've also seen a little bit of an improvement when it comes to strategy and consultancy services. So what does this mean for Indian companies? Well, considering the fact that we've seen industrialization of digital services, and we've seen acceleration in the US, especially financial services, this can augur well for something like a Tata Consulting Services or Infosys or even Cognizant for that matter. And on the other hand, we've also seen stronger demand for consultancy and ERP. In this case, we can see benefits coming for Infosys as well as something like an HCL Technologies. Of course, CLSA does point out that while a lot of these Indian IT companies stand to benefit, the fact that Accenture has gained, it shouldn't be because of its market share that it has made over the Indian IT companies. But on the whole, it certainly looks good for Indian ITs based on what we see for Accenture.
Agam, thank you for that. Wind power is now the cheapest form of energy available in India. Tariffs have fallen to its lowest level, below the cheapest solar tariff in India, in the latest round of auctions, that is. Bhanvi Arora is joining us from Delhi with the details. Bhanvi, who bid, at what price, and why this fall?
Wind power generation has become the cheapest form of electricity in India. The prices crashed to rupees 2.43 per unit yesterday in the Gujarat wind auction. The auction was conducted by Gujarat Urja Vikas Nigam Limited for 500 megawatt grid connected wind projects in India. Now this is even lower than the solar power tariffs in India. The auction was won, the bid was won by Actis-backed Spring Energy for nearly 200 megawatts. Another wind power generator, KP Energy, also matched the bid but has a smaller capacity of 30 megawatts. Verdant Renewables, KP, Betam Wind Energy and Powerika were the second lowest bidders, quoting a price of rupees 2.44 per unit. Now this is the fourth round of auctions conducted in India ever since the policy has come into force. However, this does not augur too well for the wind turbine manufacturers who have to lower the prices of their equipment and meet the expectations of the developers.
All right, let's get another view on this important and interesting development. Shantanu Jaiswal is analyst at Bloomberg New Energy Finance, joining us also from Delhi. Shantanu, afternoon. Thanks so much for coming in on the show. So what is your sense? Why did tariffs fall this far? And of course, everyone's asking whether these kind of prices are sustainable or not.
Yeah, thank you first of all for having me over here. And the prime reason why the tariffs have fallen in the wind industry is because of rising competition amongst the wind power developers. Previously, the wind industry used to get a feed-in tariff, a tariff which was determined by the state electricity regulators, and the inputs to these tariff determination process was given by the wind industry itself. But what has happened since February 2017 is that the wind industry has moved towards a competitive bidding mechanisms, which puts, which pits all the different power producers against each other, and thereby the competition rises, and we have seen the prices decline.
Is wind getting a lot more attractive than solar, and are there more takers, or is it that the players in the wind sector, are they financially stronger?
Yes, so definitely there has been an increase in the number of players who have joined the wind industry in the past 2 years. So we have seen some global utilities or investors who have started taking large bets in India. But primarily, the reason why wind has become more competitive, or one of the cheapest forms of energy currently, is because of two things. One is the fall in capital costs. So if you look at the wind turbine costs, then after the first bidding that happened in February, the prices have fallen by almost 1 crore rupees per megawatt, which is substantial. And the second thing is that wind industry is also learning as it goes forward. So we have seen the performance of the machines and the generation from the projects increase consistently over the past few years.
Just what about solar as well? This government bet big on solar right when it assumed office in terms of policy initiatives and incentives and so on. Has it quite played out that way for all the stakeholders in the ecosystem?
Yeah, if you look at the reason why solar or renewables were brought into play, or they were given a higher importance, is because the government wanted to ensure a cleaner form of energy. They wanted to provide cheaper electricity, and they wanted to provide power for all. So if you look at these metrics, then probably the government is on target. It has been able to lower the cost of electricity. As you can see, wind and solar are, if you look at the new cost of new power plants, then new wind and solar project are much lower in costs when compared to a new coal power plant or a new gas power plant. So government has achieved those targets, and if you look at the electricity consumption in India from renewables, they are also increasing progressively. So yeah, the government is meeting those targets. However, what we have also seen is that there are some concerns raised by the power developers as well as equipment manufacturers. So there are certain risks that people would have considered previously, but they are not factoring them right now and taking aggressive bets. And the margins in which the equipment manufacturers and IPPs were operating, they are also thinning. So as long as there is more innovation coming in financially and product-wise and project-wise, I think these could go on, but we'll have to wait and see for that.
Shantanu, there was also a brief period of concern about whether states will honor PPAs with the renewable guys because of pricing issues and changes in pricing dynamics. What's happening on that front? Are states walking the talk? They're committed, yes, in thought to support renewable energy, but are they actually doing that?
Yeah, so that's a fair question. And if you look at, as I mentioned earlier, the consumption of renewable electricity is increasing in the country. However, there were a few concerns in the past 6 months wherein the states tried to renegotiate the tariffs of some of the plants that were commissioned and some of the plants that were that had been bid out. So Thankfully, nothing untoward happened over there, and the central government was, siding with the power producers, and it always advised the states not to renegotiate the tariffs and not to walk away from it. However, the bigger question that we need to figure out is whether these states, they need so much power or not. Because if you look at how the power supply and deficit situation amongst these states and how they have reported it to the central agencies, it seems that there is no power deficit reported by these states, although there is a latent power demand, and a lot of places you can have power cuts of as long as 8 hours. So unless and until the downstream issues are resolved, there might be issues in meeting the targets what the government has set for renewable energy industry as a whole.
Shantanu, we'll leave it there. Thank you so much indeed for joining us. Shantanu Jaiswal from Bloomberg New Energy Finance, talking about what the situation in the solar industry is and vis-a-vis wind, where tariffs have fallen to a record low. The government, meanwhile, had launched its Housing for All scheme with much fanfare last year. But 12 months later, it's running far behind its own target of building 51 lakh homes by the end of this financial year. This, despite government press releases and statements claiming that more than 50 lakh beneficiaries have already received at least their first installment sanctioned under the scheme. What's holding it back? What's holding new construction back? How many houses have actually been built so far? Purva Chitnis joins us with some of those details. Purva.
Yes, Harsha. So the government's target is to build 51 lakh houses by the end of March 2018, and this was a program which was earlier the Indira Awas Yojana, which was restructured and relaunched last year November, and in the last 1 year the government has built 10 lakh houses. So taking forward, the government claims that it will build up to 25 lakh houses by Jan end, 35 lakh by Feb end, and 51 lakh by March end. So the overall target is to build 1 crore houses by March 2019, and the centre is providing an assistance of 1,50,000 to the beneficiaries, including all the grants under housing. And so far 57 lakh beneficiaries have already been sanctioned houses, and 51 lakhs of them have already received first installments, and these are houses across India, and states like Chhattisgarh, Madhya Pradesh, Maharashtra, Rajasthan are leading than other states. Over to you.
Purva, thanks so much for that. I think Purva has been reporting on the difference between targets and actual sort of implementation across sectors, whether it's roads and now housing as well. Switching focus to the banking space, we got the RBI's twice-a-year financial stability report yesterday late evening. Some important and interesting takeaways which you want to detail. I think the key takeaway, though, was the RBI's confidence that perhaps this bad loan problem is actually starting to end. So if you look at the first chart, which will give you the manner in which gross NPAs have moved higher, we all know what's been happening over the last 2 years. And if you look at public sector banks in particular, which is on your screen at one end of that chart, and all scheduled commercial banks on the other end of the chart, you have seen a steady rise over the last 2 years. Actually, quite a sharp rise. Steady is not the right word to use. But I think what you got away from this financial stability report is that finally you may be close to hitting a bottom on this bad loan problem. That doesn't mean that bad loans will not rise further from here on. The RBI is projecting that gross non-performing assets will hit 11.1% of all loans by September 2018. That's the net NPA ratio as well. What they then go on to say is that stress in the banking sector, particularly in the state-owned banks, while significant, appears to be bottoming out. I think that was the key takeaway, and that is something that investors in the banking sector, plus those who are watching the banking sector, will certainly hold on to. Of course, there are various other elements to look at. Industries where stress has risen to levels well before what it was earlier, and the obvious suspects there are sectors like steel and power, metals. Those are sectors where stress has been rising. You'll see that chart on your screen as well. You will see that construction is another sector which remains stressed, as does mining and quarrying. So those are some of the sectors where stress is focused on. And of course, large borrowers is where you've seen most of the stress emanate, and in that context, the RBI points to the gross NPA ratio on large borrowers, which is also remaining at an elevated level. They go on to say that concentration risk is there in some banks even now, and about 6 banks they say are exposed to concentration risk. Those banks could see their capital adequacy ratios fall to below the regulatory minimum by September 18. However, of course, there is a large recapitalization plan that has been announced, and the Reserve Bank of India saying that will certainly help ease some of the capital stress, at least on the banking space.
Interesting that. Let's move on. Any deviation from the fiscal target should be reserved for only exceptional shocks. That's a message coming from former Deputy Governor of the Reserve Bank of India and Executive Director at IMF, Dr. Shubir Gokarn. Speaking to Bloomberg Quint's contributing editor Praveen Chakravarti on our special show Noise to Signal, Gokarn says planned policy changes cannot be treated as exceptional shocks. Here's a slice of that conversation.
The issue of fiscal prudence sort of transcends in individual circumstances. Of course, you can always argue that rules, when they're designed, have to accommodate shocks. They have to be flexible enough to, not to lock the government into a situation where it cannot respond to a shock. So I don't think there's any practical rule in place which does not give this flexibility. But then there have to be very clear boundaries, if you will, or understanding on what are the circumstances in which these rules can be bent, or where the flexibility comes in. And typically in rule formation, these flexibilities are given to the government to deal with a very severe exogenous shock, and not sort of necessarily, and of course one could debate what an exogenous shock is, but a policy transformation will have its own consequences, and you want to sort of use that flexibility to accommodate this, I think becomes an issue, because the ultimate test of a rule is credibility. How, once you set it up, how committed are you to adhering to it? This is true of inflation targeting, this is true of fiscal rules, or any rule for that matter. And if you undermine credibility in whatever fashion, then the value of the rule is gone. Then you might as well just go back to a discretionary kind of framework. So if you're committing to rule, and I'm talking generally, I'm not talking specifically of India. If you're committing to rule, then I think you have to accommodate the possibility, or the reality, that there are very, very limited circumstances under which the system will tolerate deviation before before sort of saying, look, there's no credibility to that rule. And I think the benefits of the rule also have to be seen. Why are you getting into rules in the first place? It is largely because in the absence of a rule, the kind of fiscal space that you need to pursue what might be considered sort of high priority, national interest and growth and inclusion and all of those very, very critical objectives. That space remains, and for example, if you are committing to an infrastructure, a publicly funded infrastructure strategy, and 1 year down the road, something happens which reduces the resources flowing into this, your strategy falls apart, because you cannot be stop and go on these kinds of commitments. Now we have many requirements that are going to put pressure on the fiscal situation from a long-term perspective. You have to make commitments, and you have to be consistent in your commitments over time. Infrastructure is the primary example, but there are others as well. And if you're not able to adhere to those commitments, the strategy falls apart. So I think rules help in allowing the government to make these kind of longer-term commitments with credibility, with assurance that the resources are going to be there, and that people can actually come in, whether it's PPP or SPVs or whatever mechanism, that you can actually start doing that, putting those things into play.
You also represent countries such as Bangladesh and Sri Lanka on the board of the IMF. The one puzzle for us here in India is our exports growth. Just when the IMF projects 4% growth in volumes, which is, I think, the highest in about 6-7 years, and there's robust growth everywhere, India's exports are languishing, certainly losing market share in sectors such as textiles and apparels to countries such as Bangladesh. I'm assuming you've observed these countries quite closely. So can you explain what explains some of the rise of Bangladesh in the world exports market?
Bangladesh, 80% of Bangladesh exports are garments. And I think what you're seeing to some extent is the power of concentration, of focus, but also along with the focus come big risks. You know, the system has to be sensitive.
So when you say focus, like policy focus?
Well, you know, if you it's like you could say a sort of picking winners kind of thing, which is that the whole system is geared towards satisfying or meeting the requirements, the interests of the garment industry, because it's so dominant in their sort of on their radar screen, and so everything that comes in their way is dealt with fairly quickly, and it's paid off. I mean, in terms of growth, in terms of the employment that garment manufacturing generates, and the garment manufacturing community, the constituency, has become a very influential community in terms of their impact on policy decisions. So if there's a problem, they are heard, and there's every attempt made to address it. We are much more diversified. We have multiple lobbies or constituencies, and so being able to focus on one thing, I think, is a little more challenging for us. We've had successes in the past where pockets have worked. IDES is one example. Auto components is another. Pharma is a third. There are a number of them. But as people have pointed out, these are not necessarily the sort of labor-intensive, traditional labor-intensive manufacturing activity that we would like to succeed in, where our exports perhaps have languished a bit. So I think where we not...
Any policy lessons, specific policy lessons?
I think the larger debate in India on facilitating employment through reform of the labor regulations, through a combination of market flexibility, safety net, and skills. That's to me the triangular sort of model for employment generation. We have to try that. We have to put effort, and so it doesn't confine itself to garments. Garments will be one part of it, but there are other things that can benefit from this combination of
but is there empirical evidence from Bangladesh, for example? I mean, did they indulge in labor reforms?
Oh, absolutely. They had no legacy of the Industrial Disputes Act and its reforms. So the Bangladeshi labor market is, in a sense, what we have been aspiring to, which is great flexibility. So if business slumps, there is nothing that prevents workers from being fired. But because there is so much buoyancy in the industry, jobs are not very difficult to come by. So in a sense, there is a safety net provided by that focus. Because not the whole industry isn't going to slump at the same time. Individual producers may. And so they're clustered, so that if you lose, it's Silicon Valley, clustering the benefits. If an IT company shut down, there are 5 others that are willing to hire your particular skill set. And in a sense, that is what works with clusters.
Right, interesting conversation there. You'll hear snippets of it through the day on Bloomberg Quint. Let's slip into a quick break, come back and talk Bitcoin, except this time it's not about Bitcoin rallying higher, but about reversing its rally. We'll get you that in a bit.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Business news, we're news for business people.
Welcome back. You're watching Power Lunch. Let's get to the headlines at the half hour. The Indian markets going into the Christmas weekend on a cheery note, just about 10 points away from 10,500 on the Nifty.
Bitcoin sinks 21% today. The cryptocurrency extends its losses to 40% this month.
Stress in the Indian financial sector remains high, but it may be close to bottoming out. That's the message from the Reserve Bank of India's Financial Stability Report.
One of the most interesting stories that's captured the imagination of traders this year has been the Bitcoin mania. The cryptocurrency has now fallen 40% from its peak to trade below the $13,000 mark. Over half of those losses have been made just today. That's 20%. Take a look at that chart. That's the yearly chart for you, Anira. Many of the guys who've been tracking Bitcoin now say this has now entered a bear market. Traditionally, a bear market is when you have a 20% fall. But when an asset class like this moves 1,100% year to date, there's very little you can say other than the fact that I suppose it is getting formalized. The CME launched futures trading. Goldman Sachs is setting up a crypto desk. The last I saw was that there's a senior executive director of Morgan Stanley. He's quit his job to join a trading desk for trading in Bitcoins. You don't know which way this is going to play out, right? And then another interesting trivia on this, the amount of power apparently that Bitcoin uses is equal to the power consumed by the country of Denmark. So leave that trivia with you. But if you have to have you've got to have nerves of steel to be playing in Bitcoin.
And we were having a nice chuckle about the story of the Long Island iced tea company, which has added blockchain to its name and rallied some 200%.
500 and close at 298% up. So all you need to do is add the word blockchain to whatever you're doing, or crypto to whatever you're doing, and the market seems to be loving it. But hell, this is reality. Stocks are actually, the value is actually moving up.
Yeah, all right. Back to more mature markets, and that is equities for you. Pradeep is here with a dipstick into what's happening in the market. Pradeep, we are heading towards new highs.
Yeah, so Merry Christmas on Dalal Street. We can say, Nifty very close to that all-time high, and it doesn't really matter if you miss it by a few points. But the point really is, this is the third series in a row when we are getting stuck between 10,450 and 10,500. So a decisive breakout above 10,500, we stay there, we build some more 50, 100, 150 points over and above that would really matter, not at 10, 15 points here and there. So today, market breadth remains good. Even mid cap, small cap are doing fine. Some of the stories that we have been tracking is IT. After that, upgrade by Accenture, or stocks have moved up. So not only the leading players, but also Hexaware is one stock in mid-cap space which has moved up with good volume. So that is one to watch out for. A similar uptrend in PSU banking. Maybe after the RBI comment, that probably NPAs have kind of peaked out, and you see Allahabad Bank is an interesting mid-cap that I have spotted among mid-cap PSU banks, which is doing good with volumes. Adani Group and ADAG Group are buzzing. Now, one stock here worth talking is Adani Power. So this stock has also moved up today, has seen decent buying interest. And it is punter's favorite, of course. If you look at some of the mid-cap stories, tire stocks are doing quite well today. Most tire stocks have moved up with good volume. CEAT specifically is one in point where we have seen significant buying interest both on futures and cash side. And also there is significant build-up on the long side. Some more stories that market has been looking at is maybe some infrastructure stocks like HCC and Dilip Buildcon. Or you have some stories like Sandesh doing well, second day in a row, and Aarti Industries on buyback plan that they have come forward. Now, stocks which are not moving today would include RCom. After last 2 days up move, there is definitely some pressure here. IFCI is not moving today, also because both these stocks have moved into ban in FNO, so you can't build fresh positions. That could be a reason. But Unitech has also fallen. Interestingly, all those stocks that moved up after 2G verdict, DB Realty is the only one which has kept pace and is intact at 20% upper circuit.
Interesting that. Thanks, Pradeep, for that. The party, meanwhile, in India may not continue in full force in 2018. Bharat Iyer of JPMorgan believes that Indian markets will rise, but not as sharply as we've seen this year. The reason? Liquidity. Liquidity is likely to dry up globally as central banks from the US to Europe hike interest rates significantly. That's his view. Listen to this conversation we had with him earlier in the day.
The way I look at it is, we're trading at 19 times.
I really don't think there's too much scope for further re-rating on the valuation front.
On the valuation front.
Because, let's face it, valuations were driven by two factors. I mean, one was very easy global liquidity and easy monetary policy by central banks in the developed world. That seems to largely be coming to an end, and we've already seen some kind of normalization, at least with some central banks. So I think that variable is out of the way. Secondly, even if you look at it in the local context, I think we saw a very meaningful improvement in local variables, including the fiscal account, the current account, inflation. I think most of that improvement has peaked. And near term, we could see some mean reversion. And even here, I think we're largely done with monetary easing. So I think here onwards, the heavy lifting will have to be done by earnings rather than valuations. On earnings, our take really is that we still think street earnings are a little frothy. For FY18, the street is at about 13-14%. I think for the first half, we ended flat. So I think the second half then we'll have to do 25% plus, which looks unlikely at this stage. So I think 8 to 10% is more like it. And for next year again the state is at 23-24%. We think it'll be more like 14-15%. But that said, yes, I mean have we bottomed out and are we going to see a bit of improvement in the trend? Yes.
Perhaps so the process of global monetary policy normalization started this year actually in some ways, right? Why is the assumption being made that next year is the year when it will start to bite? Is it because the Fed's balance sheet reduction sort of moves along? Is it that ECB is expected to join in? Because the BOJ will not.
Yes. I think it's a combination of factors, Ira. I think what's going to happen is, as you rightly pointed out, central bankers in the developed world were just wetting their feet, if I may use that expression, in terms of normalization this year. Whereas next year, we do expect that this process will gain momentum. I mean, we've seen 2-3 rate hikes so far in the US over a period of 2 years. Next year, our house view is that we'll see 4 rate hikes, though the market at this point in time is pricing in only 2. Yes, as you said, the pace of balance sheet normalization is gathering momentum. The ECB will at some point in time join the same stance next year, and the BOE is probably already there. Again, we're seeing something similar from the PBOC, and so I think with the exception of the BOJ, yes, everyone seems to be moving the other way. And I think the key data point to watch out for is how core inflation pans out, because we're getting there, and inflation, as we all know, is a bit of a hockey stick phenomena, and you just hope and pray that things are normal.
So you do think that fund flows will start to look a little bit softer next year? They haven't been great this year into equities, at least. They've been great into debt.
Yeah, they've been great into debt, but again, let's face it, we still got $8 to $10 billion.
Yeah.
And if you compare it versus the last 2 years when we were averaging only $4-5 billion, yes, a far cry from the $20 billion we were making between 2000 and 2014 and so on.
Yeah.
But yes, I mean, we definitely need to watch out for that. That is an important variable.
Interesting. So, Bharat, what goes out faster? Because I remember conversations start of this year wherein most people believed, and I don't know what your belief was, that equity flows were but a derivative of the kind of strong flows that were coming into the debt market. If you indeed believe that debt market flows also will not be that strong, are we to presume that this spate of outflows that we've seen from the equity markets, save for November, could actually accelerate? And people would argue there are factors for that with the rate hike, and maybe the US tax reforms also aids to that process. What is your core belief?
See, I think if it's always difficult to predict flows, Neeraj. I mean, if you ask me honestly, I mean, I've been trying to do it every year for a few years, and I've just realized it's a mug's game. I've always got it wrong.
You've given up.
So it take me with a lot of skepticism. But I think at the start of the year, the base case would still be like I mean, we do have an internal model that throws out numbers, and the base case we have right now is that we continue to get about $8 to $10 billion into Indian equities next year as well, because obviously, as you said, the global macro situation will get more challenging as we go into the year. But that said, the initial part of the year should still be, quite healthy and reasonable. Secondly, also, I guess fund flows are a function of, some bottom-up stories as well. I mean, even this year we saw, we had a spate of outflows for 3 or 4 months, and then we had this very high-profile IPO, a high-quality IPO, and then it attracted a lot of attention. So, you have to make allowances for that as well. Okay. So, yes, the base case is 8 to 10 billion, more front-ended rather than back-ended, but let's see.
Okay, and part 2 of my question would be, are we now, as a market, reaching a point or have already reached a point wherein the global flows will not really determine or dictate what happens to levels and sentiment, because the locals are coming there. The conversations, and you would have had to, when we've spoken to fund managers and we talk about what will happen if indeed the rates go up and the flows go out, almost everybody has said, hum hai na, we will come in and park in the money because we believe that the flows are here to stay.
See, Neeraj, I'll answer that question in two parts. I think, see, first and foremost, the development that you are alluding to is a very positive development. Because, let's face it, the Indian household is underinvested in equities. And, this is a structural trend. It's not a cyclical trend. So, you will see more and more money coming in, and which is good. Because, you want the household to make better money than the debt markets can give them. There is a tax advantage out there. And also, I guess, it's positive for both the markets and the economy because it enables us to de-risk a little from global happenings. But that said, I mean, are we going to be immune to a global sell down just because, local investors have become relatively more powerful? Unlikely. Look at the math. I mean, you have the FIIs own what, 22% of Indian equities? The locals, including the Life Insurance Corporation, own 11-12%, and the LIC is half of that. So, and keeping them aside because they tend to have various considerations. I mean, 5 versus 22.
Yeah. And the other point, sir, is, I mean, I know I hate to be the voice of skepticism, and we all hope that the domestic sort of, flows continue, but we don't know that they will continue until you hit a down cycle.
True. Absolutely, you're very right, Ira, because, there are 2-3 issues here. I mean, which is what even it's a point even we like to make, that, if you're getting, say, $2 billion into equities every month, I mean, all of it is not structural. I mean, you could argue that, about 800 million is structural, about 1.2 billion is cyclical. And, it's not that the local investor is just going to keep investing in equities at all levels.
Yeah.
I mean, this is a very smart investor. Let's face it, between 2012 and 2014-15, the local investor, stayed away from equities or the financial markets at large, invested in debt, invested in real estate and property and gold when inflation was going up, did very well. At the right minute, made the switch into the debt markets. At the right minute, made the switch into the equity markets. So, and the relative attraction of debt is on the margin going up. I mean, the 10-year bond has gone up by 80 basis points in the last 4 months. So, I mean, yes, that's why, as I said, there is a structural component to it, there's a cyclical component to it. The structural perhaps endures and stays. The cyclical component will have its ups and downs.
Bharat Iyer of JPMorgan. The Nifty 50 has gained more than 27% in 2017, the highest in 3 years. A few stocks contributed more to its gain than others. Some even beat analysts' predictions in January. Then there are others that were below par. Somit and Anirudh Saligrama have put together a list of Nifty outperformers and underperformers. Before we get to Somit on the names, here's a quick word on the methodology. We shortlisted only those stocks that are currently on the Nifty and are covered by at least 10 analysts. So, Somit, what have been the biggest surprises this year?
So, I'll start off with the outperformance at the Nifty 50. Top of the list is Bajaj Finance. Now, on 1st of Jan 2017, the Bloomberg consensus analyst target price for Bajaj Finance was 952. And yesterday, Bajaj Finance closed at 1,748 rupees per share. That is outperforming the consensus target price by 84%. Similarly, Tata Steel outperformed by 76%, Maruti Suzuki by 59%, Reliance Industries by 54%, and HUL, that is Hindustan Unilever, by 49%. So what led to this outperformance for these companies? For Bajaj Finance, it was strong growth in asset under management with focus in consumer segment and strong traction coming in from rural side. Also, steady asset quality throughout the year worked for Bajaj Finance. For Tata Steel, it was improving steel prices both in India and Europe, and along with that, margin expansion in India and a complete revamp of its Europe business, which not only included solving of pending issues, but also a new joint venture in Europe business. For Maruti Suzuki, which is one of the most profitable car manufacturer globally, it was strong volume growth in the passenger car segment, and along with that, they also consolidated their market share with on the back of limited competition. For Reliance Industries, which is the most valuable company in India, it was their telecom venture, that is Jio, that surprised the street because it grabbed a good revenue market share and a subscriber base, and also posted strong financials in the last quarter. Along with that, in the steady, they also posted steady core business, steady performance in the core business, that is the refining business. For HUL, it was good volume growth in market conditions where competitors were reporting decline in volumes, and along with that, strong margin expansion despite input cost inflation. Now let's see the underperformers. Not much surprise here because in the top 5 there are 4 pharma companies. So Lupin, on 1st Jan, the 12-month target price was around 1,700 rupees. But yesterday Lupin closed at 879, that is underperforming the target price by around 49%. Similarly, Sun Pharma underperformed by 36%, Aurobindo by 29%, Tata Motors by 27%, and Dr. Reddy's by 25%. So let's see what didn't work for these companies. For the pharma companies, it was consistent pricing pressure in the US market, aggressive competition because the drugs being generic, slowdown in the key US market, and heightened and frequent scrutiny by US FDA was a consistent overhang on pharma companies. For Tata Motors, it was demand softening in US and Europe, weak and aging product pipeline of JLR, and margin pressure, consistent margin pressure throughout the year remained a concern for Tata Motors.
All right, Samit, thanks so much. The leaders and the laggards among the larger stocks that are well tracked, but this is also, like any other year, perhaps been a year where we've had multi-baggers, large multi-baggers. So which have been the big ones of 2017? Darshan Mehta and the research team at Bloomberg Quint have been tracking those companies. Today we are featuring a company called Goldstone Infra. We've got Darshan joining us with a sense of what the company does and how it's performed. Apologies for that. Darshan, over to you.
Yeah, so the company is Goldstone Infra. It's up almost 7.5 times this year. Now let's take a look at what the company does so you can get an indication of what exactly was the reason why this move happened. Basically, the company manufactures and supplies composite in insulators. These are products that are used in transmission and distribution lines. So the T&D business, and it is also used in railways. Now the big trigger came when they entered the electric bus manufacturing. In the second quarter, the first bus was rolled out. So that is where the traction really happened for Goldstone Infra. Now, if you're looking at the other parameters as far as Goldstone Infra is concerned, the valuation, if you're looking at the valuations currently and the return ratios, single low digit on return on assets, equity and capital. So in terms of return ratios, not the best. And in terms of look at the price to earning ratio, this is current. So the average that it did for the full year is 17 times, the lowest 10 times when it was trading normally, and currently it's trading at 45 times. So the valuations have gone through the roof as far as this company is concerned. Now look at the breakup. So there are two businesses, the insulator business and the electric bus vehicle. So in the second quarter, where the electric bus came in, 25% of their revenues came in from the electric bus and 75% from the insulator business. But look at the profitability or earnings before interest and tax. 95% of that came in still from the insulator business, while the electric bus, despite contributing 25%, got in just 5% of the profitability. So despite the revenues growing up, you can see that the EPS or the margins have not gone up. So they were very constant between 90 to 100 crores. In the first half, they've done 62 crores. If you analyze it, gets to 120 crores. That is because of the electric bus coming in. EPS actually hasn't moved much because the profitability has not come in. So they were consistently, so even if you annualize this, it will still be lower than what they did in the last 2 years. And margins have come off from the 19%, 20% to 14% because of the cost involved for some of the projects that is there. So this is the financials. And take a look at the debt. The debt has gone up given the fact that they needed capex for their bus, and they have cash of 11 crores on the books. Now, if you see what happened in the last 4 quarters, this is where it tells the story. They were doing 20 to 30 crores. The big jump up came in because of the electric vehicle bus that they launched in. But the profitability, look at it, it's similar. There's no change to that, which gives an indication that the market bet significantly on the stock price because of the electric bus, because of all the things that were going around with Tesla and the electric bus, all that happened. What worked for it? Electric vehicle foray, that was the most important thing. Secondly, they had got orders from BST as well as HRTC. So that is the electric. The second important thing is that the promoters gave themselves 54 lakh warrants in October when the price was 100 and the warrant was at 80, and 1.5 crores allotted to non-promoters in October. So clearly that was when a few HNIs came in and the promoters themselves took in warrant, and that is why, and that combined with the electric vehicle foray actually caused the big surge in the price. But now we'll have to see whether the numbers come or no. What are the concerns? Valuations have run up significantly post the EV entry, and finally imports from China in the insulator business as well as the bus business is something that could impact the company going ahead.
Darshan, thank you for that. That's the story of Goldstone. Myntra, meanwhile, is betting on artificial intelligence to help them judge consumer demand and manage logistics better. In a conversation with Bloomberg with Nishant Sharma, Myntra CEO Anant Narayan says AI will help speed up delivery. He also says Myntra's initiative to tie up with mom-and-pop stores has boosted sales by about 25%. Listen.
So we started the Kirana initiative almost 7 months ago. We had about 800 Kiranas for the last URS. This time we'll have 3,600. So dramatically higher. And the reason it's helpful is it actually provides us the capacity that we need, the spike in capacity that we need right after this, right? Right after URS. Also, just given the timing, we're trying to get a majority of the packages through before 1st of January, right? So that it hits people before New Year. So that's what we've done. We've also used a lot of technology this time and a lot of AI and machine learning to actually think about what will actually get sold. And can we actually start to forward deploy some of that even before it gets bought?
Right, and I've read somewhere in the news report that this works as a last mile delivery, enhancing the speed of products.
Right.
Are you also tying up with these kiranas to also have an omni-channel presence as well, where customers can have a touch and feel?
So early days for that. I think those are still plans in progress. So for now, I think it's just last mile delivery. We might do more with them, of course.
Right. And is it just only for the sale events, or it's going to be an integral part of?
It's going to be an integral part of what we do. I believe that it's actually better for consumer experience as well, because they're actually local, they know the area, they know the customer. So if we can create a sustainable business model for them, so that they actually make a bunch of money, it's also giving back. At some level, if you think about it, we're creating 3,600 micro entrepreneurs who are actually now running their own business. So yes, we want it to be an integral part of how we do
And
business.
how does the partnership work?
So they make money on the packages that they actually deliver. We make sure that there is enough cash flow that actually works through. We are actually among the most frequent payers in terms of how frequently we pay the kirana stores. So, and that's all tech enabled, so that it's actually faster and can be done at scale.
AI and how it's changing businesses. Before we end the show, autonomous control, a United States of Europe, and the emergence of a new currency. These are just some of the grey swan events identified by global investment firm Nomura as their grey swans for 2018. The brokerage house says it never hurts to be prepared.
If you think machines taking over the world or a brand new United States cropping up on the other side of the Atlantic are impossible scenarios, think again. Nomura, an investment bank, believes ingredients for these grey swan events already exist and could even take shape as early as next year. Take Terminator Salvation, a movie that's actually set in 2018. Skynet is a computer system that can control everything from mobile phones to drones and cyborgs. It might have sounded like a distant sci-fi fantasy back in 2009 when the film was released, but computer-controlled drones, power grids, transportation and food systems have already made their way to the real world. So has advanced machine learning and AI. Let's just hope if a real-world Skynet does emerge in 2018, it doesn't see humanity as its biggest threat. Brexit set the stage for all European countries to re-examine their relationship with the EU. With no major elections next year, countries can focus on the big picture and try to achieve the long-standing dream of many federalists on the continent, a United States of Europe. In fact, the President of the European Commission and even Emmanuel Macron think this could be achieved as early as 2025. For every analyst who believes Bitcoin's best days are behind it, there are several who've gone on record calling it the $100,000 coin. But Bitcoin has had little impact outside the cryptocurrency world. Back at NYSE, life goes on as usual. But that could change in 2018. The arrival of Bitcoin futures will see Bitcoin exchange-traded funds enter the stock market. The currency, which still remains highly volatile, could really shake up every stock market it enters. Japan, where 50% of all Bitcoin trading occurs, will see the biggest impact.